Hi there. Good evening, everyone. Welcome. Thank you for joining me at this exclusive webinar on tax and finance for high net worth individuals living in Portugal. I can see there's many of you joined today from different regions. Actually, I obviously spend most of my time down in the south around Valdelobo, Quinta do Lago, Vilamura, but I can see we've also got some people up from Cascais and Lisbon and some other areas in between, perhaps Lagos and stuff as well. So listen, thank you for joining. I'm sure if you've not heard from me before, my name's Ryan Edward Donaldson. I'm a chartered wealth planner and I do a lot of work between the UK and Portugal to help people around with their wealth planning techniques. If you have seen me before, forgive me if there's a few repeats throughout this presentation. I can see there's a few names that I recognise. However, there's some new, fresh updates which I'm sure everyone on the call will get value from. So we'll get to it. Just as a way of putting structure on today's presentation, I'm going to start with a brief introduction as to who I am and the company I work for. We're then going to look at the Portugal non-habitual regime changes that's happened over the last few years. We'll then take a look across at the UK side for all the British people on the call, at the UK budget, the Labour administration, changes to inheritance tax, pensions and inheritance tax, and foreign income and gains rules. Then I'm just going to give you some little key financial planning tips around the new non-habitual regime, whilst also taking into consideration the UK. We'll then round off with what Portuguese property capital gains tax relief means, i.e. selling your primary residence at retirement. And then the final point is some repatriation advice for anyone who is in Portugal, perhaps an expat. You may be thinking about leaving Portugal again. So we'll just cover some key countries and some key financial planning techniques to take on board. Yes, as I said, as way of brief introduction, my name is Ryan Donaldson. I've worked with Skybound now for 11 years. I've worked all over the globe with them, to be honest. But my current registrations and where I focus most of my time on is across the UK and this European central belt. So covering France, Switzerland, Spain, Portugal. I spent most of my career in the Swiss region, and then during COVID, most of my clients moved back towards, France, Spain, Portugal, UK. So I cover these five key jurisdictions. Where my passion lies and where's my expertise lies is helping people with cross-border financial planning. So it's helping people understand how to navigate between different governments, different how they treat different assets, different tax regimes, and how they should structure their assets to fit with that specific regime. If you think about it, if you end up in the UK or you end up in France or Portugal, the vehicles and the structure that you should be using to help draw down your income or draw down your vehicles or design your investments actually look very different, despite them being, quite closely neighboured across the waters and across Europe. I'm registered in the UK by the Financial Conduct Authority, also registered by MiFID II, ARIF in Switzerland, and I'm also on some of our Middle East licenses, which I keep up with. The company I work for, Skybound Wealth, started as a UK financial planning company 26 years ago, but then they expanded all over the globe. So they kind of started off kind of Mayfair, Sheffield, London Bridge, down in Dorset, but now got offices across in Miami, Henderson, down in South Africa, across Europe such as Geneva, Abu Dhabi, Dubai, and also now Malaysia, which has just opened as well. The only thing that matters to perhaps everyone on the call is to understand that each area we operate we're regulated locally. So for example, if someone was on the call with perhaps US assets, although I'm not particularly a US expert and I don't have a US focus, we have a range of consultants who are Series 65 qualified, SEC registered, and they would come onto the call to perhaps assist you with those specific assets. And that's the same for every jurisdiction, FCA UK, MiFID II Europe, as I said, ARIF FINMA Switzerland, and so on and so forth. So it allows us to provide localized advice whilst also doing the cross-border advice, international planning at the same time. And these are just a range of the licenses here which I've covered. A general advice disclaimer today for everyone on the call. Firstly, at this stage on this webinar, all of the information should be taken as information at this stage. The reason I say that is we're going to be looking at case studies, having discussions around financial planning tips, but I don't know your position, your exact position to the levels I would have to give you financial advice. There may be little things in there such as citizenship or residence in between two countries that could affect things. So please take it as information. Of course, if you want to receive financial advice specific to you, more than happy to do so. And I actually carry out initial discovery meetings for no charge if you want to share some more information, and we can go into that in a little bit more detail. One more general advice disclaimer is Skybound Wealth Management and myself, we're not tax specialists, so we're not tax advisors. We are wealth managers, so we do everything from financial planning, pensions, investments, insurance, property investing, and a whole wide range of vehicles. But in terms of the tax planning part, we work with tax partners, which are documented on the next screen. We work with tax partners across Europe, UK, Portugal, local, of course. You'll recognise some of these names. So a lot of the information I'm giving you today is based on my understanding and my previous case studies from dealing with our tax partners. Of course, if we're going into a detailed financial plan with you, we would design your plan and we'd bring a tax partner in to confirm it if that's what you wish, but we'd always recommend seeking professional tax advice. Okay, moving on to Portugal then. So the non-habitual regime in Portugal has been in place since 2009. And I can imagine that many of you in the call are actually on the non-habitual regime, but without going over it all in too much detail, you've got the non-habitual regime, the initial regime, which was set in 2009, when the big attraction there was that people coming into Portugal, foreigners or even people that have been outside for 5 years, could come into the country and receive foreign income at a rate of 0% for a 10-year period, and that included pensions and foreign income from employment. Then it changed a little bit in March 2020 when it went to a 10% regime. So rather than people having no tax for 10 years, anyone who came to the country after March 2020 would consecutively receive their income for 10% tax from that date thereafter on foreign income and again including pensions. So it was only just at the end of 2023, Antonio Costa, who actually resigned shortly after announcing the decree to stop the non-habitual regime. So he put forward a decree to kind of disbanding the non-habitual regime so that new expats coming into the country would not benefit from the 10% code anymore for 10 years, or previously the 0%. However, if you're on the regime, it still stands for the 10 years from which date you entered. So if you entered in 2001, 2 years before the decree to stop it was brought in, then of course it lasts until 2031. But what it means now is that for new applicants coming into the country, as of kind of 2025, is that you no longer have access to it. So that means you're coming into a new regime. Now, the interesting thing is that Antonio Costa resigned. There was some rumours about lithium battery fraud and various other things. I don't think they were proven. I think he's actually in the European Council now. But it was held up. The decree was held up. And what the kind of new government has done is they say, well, let's bring in an NHR 2.0. We still want to attract some people. Let's bring in something a bit different. So let's have a look at what that actually means. As I mentioned, the non-habitual regimes came to an end October 2023, as it used to be known. And we're moving towards this NHR 2.0. Now, the NHR 2.0, the big differences here between 2.0 and call it the two previous NHRs, because it was 0% tax and 10%, but known as non-habitual regime, is that you must actually be contributing to something that promotes Portugal, whether it's through their key industries of need, whether it's through investing into kind of a Portuguese company. It must have a legitimacy to get onto that NHR 2.0. And some of the criteria is actually mentioned on the website in terms of what would constitute that. However, and you can see that it's got scientific research and innovation at the top. There are ways that if you're coming over, there are certain companies that you can actually set up and invest in, which would give you eligibility to NHR 2.0 to then benefit from the tax efficiency. And these are things that I'm working closely with. There's a fairly new rule. So even some of the tax advisors I'm working closely with in law companies are still not finding their feet with it, but they're still assessing which areas can be addressed and which areas can be invested into. But we've already had some successful take-ups on the NHR 2.0, which may be of interest to people who are moving over to the country. Now, I say it may be of interest, but it is very different to the previous NHR regime. The big change is that The tax efficient income, the 0% or 10% income, will no longer apply on pensions. If you see this first paragraph here, it says, unlike the existing non-habitual regime, this excludes pensions. So there's no tax efficiency on the pension side for perhaps high net worth retirees looking to come over and spend a bit of the retirement in Portugal or all the retirement in Portugal. However, there are other benefits. One of the key benefits here is that something that previous non-habitual regimes hasn't included, and it's actually on this rather information heavy slide on this part. I'm going to pick out the key parts that you need to know here, is that capital gains, even on the old non-habitual regime, which people would call the best non-habitual regime, the 0% 10% codes, where you could just move over and get access, you always had to pay 28% capital gains tax. There was never a capital gains tax exemption, even on the old non-habitual regimes. Yes, you had dividend, interest, and income tax relief, but there was no capital gains. Now, as we understand, on the new non-habitual 2.0, there is actually going to be capital gains tax relief, but not the same on the income side with pensions and that part. So there's a bit of a flip. Now, that can be attractive for people coming over who are looking for work, who are looking to set up companies in Portugal, who've got money to invest in Portuguese companies and assets to benefit from NHR 2.0. And it can also be attractive for people who are coming over perhaps with big existing share portfolios in different countries and looking for ways to actually start to perhaps draw down from those over the next 5, 10 years and start to make use of them. So that's what I would say, take heed. And perhaps anybody who's thinking about moving to the country or just moved this year, that's the areas that we'd want to be discussing and how to set you up right. For people that are on this call who are already on NHR with the 10% income code or the 0% income code, then that's a different position. So please ignore the capital gains tax relief that I mentioned. You would still be subject to capital gains tax in Portugal as it stands through your non-habitual regime. However, you benefit, of course, from your exemptions on the dividend and interest. The other capital income, this is from foreign sources, of course. Anything Portuguese sourced is always taxed as normal, but the foreign sources has all the exemptions that you need. And the Portuguese stuff source will cover in more detail in just a moment. Why is this important? It's important to understand these rates, these regimes, because it has a very key element to play on how you should structure your assets and your investments. It's a very key element in terms of, well, where are my vehicles now? Are they in pensions? Are they in investment platforms? Are they in life assured vehicles? Or are they in banks, retail banks, private banks, or just trading platforms? Are they producing an income or dividends or capital gains? Or what's the best way for me to structure and get these things right during my NHR, depending on which NHR I'm on, to benefit from that drawdown and benefit from the tax efficiency? So these are the things that, of course, I go into a lot of detail case by case and we can cover. One thing I will say is that Portuguese sourced income. So if you look at this left bar, if I just break this table down, if you look at the Portuguese source side, you can see that even on your NHR, you're still taxed full for anything Portuguese sourced. Now, Portuguese income, this is by Admiral Marquis slides, Portuguese income tax is actually very high. So after NHR, so basically when you come off of non-habitual regime, on the old regime, effectively all your foreign source exemptions become Portuguese source. It's almost as straightforward as that, which with a few things in between which we can cover. You actually then got a tax between 13.25 and 48% bands. Now, just to give you an idea, the average additional rate tax band, which is the high band, in Europe is 42%. And that covers all countries in Europe as an average, 42. If you look at the UK, it's 45. Portugal's 48. And it's anything just above 80,000 in income. So you can see where I'm going with this, the importance of designing your assets, making sure you've not got a lot of income producing assets, well, Portuguese sourced, but also when you come off of your non-habitual regime, if you're staying in Portugal, you really want to be careful about what one of your assets are producing an income taxable event. Now, you've also got dividends and interest tax, which is 28% after your non-habitual regime. And you've got other capital income, which is 28%. Again, looking at the right-hand side, exemption or reduction, depending on the source under the double taxation agreement. You've also got your capital gains coming down. So you can see it's 28% on both sides, but there are, as I said, on the NHR 2.0 ways to start to reduce and mitigate that. Something just to note at the bottom here, you've got capital income from low tax jurisdictions. Low tax jurisdictions, people call it a red list, a black list, a grey list. I mean, people have different terms, different terms for that kind of stuff. It basically means a country that doesn't have a double taxation agreement with Portugal. Sometimes they have a TIA, which is not as in detail, but it basically means it's a country that does not have a double taxation agreement with Portugal. Common things that I see are people that have maybe worked in oil and gas industry or international industries that have been set up with these types of international retirement plans or international investment pots, supplementary investment pots. And they can be in perhaps more exotic places like Bermuda or Cayman Islands or Caribbean or even places like perhaps not so exotic, but a bit more kind of European onshore with TIAs, but like Malta, Guernsey, Jersey, that kind of stuff. So it's understanding how to report them and navigate them, because if they're not done correctly and understood correctly, there can just be a higher tax applied on as a capital income on a low tax jurisdiction because the DTA isn't there. So be mindful of that. I'm going to come on to some financial planning tips around Portugal and those tax rates just in another few slides after I cover the UK, because they come together quite nicely. But if you're sitting on the call at this point, I just say, I appreciate, just keep attention. If you're sitting on the call and you're really more around the kind of Portuguese tax side and UK is not, you're not British, so to speak, then after the next few slides, I'm going to come back to wealth planning techniques that's going to be specific, perhaps relevant to you. But for now, I want to talk about some of these autumn budget changes, which have been very, very important from last year. Seems a bit strange talking about the budgets a year ago, but there's been a lot of change, and the spring one didn't have as much. I want to focus on this, and then I want to bring both of them together for some key financial planning techniques in a moment. So, autumn budget 2024. We have Rachel Reeves here with a nice little red box. All right, Labour administration, first budget that's come in, big change. All right, if you're probably aware of, if you're a British on this call, you're probably aware of some of these changes, but the three big changes, I mean, the stuff around increasing tax and duty on private jets and stuff, let's not talk about the entirely irrelevant stuff at this stage. Well, maybe some of you have the luxury of this kind of stuff, but let's talk about the key big changes. One, the abolition of non-dom status on inheritance tax of worldwide assets, April 2025. It was an immediate change this year to the new residence rule. So let me just tell you what that is. From the test of time, the UK is ran on a domicile test for inheritance tax. A domicile test means it assesses your citizenship, your domicility. Where were you born? Where is your bloodline? Where was your father's bloodline? What that means is that just before this year, 2024, 2023, and years before, if you're a British national or a British citizen living overseas, even if you're overseas for 30 years, unless you've actually proved you're non-dom, which is very, very difficult, by the way, you would always pay 40% inheritance tax on your worldwide assets, because the UK inheritance tax will tax all your assets at 40% on your domicility status, your citizenship. Very, very hard to lose. Now, yes, you get your nil rate bans. You get your 650,000 if you're a married couple, 325,000 if you're single, and you get your primary residence allowance of 300,000 on top. So you may get 950, but if you get a house in London, that ban's pretty much gone. So everything above that, 950 or 650 or 325, depending on your position, is taxed at 40% on everything. Now, that's not the same today. And there's actually really famous cases, actually. There's famous cases of people trying to move abroad to Switzerland, and famous people trying to move across to Switzerland and trying to lose that inheritance tax non-dom status, but it's very, very difficult. Now, just what's changed as of April 2025, they've completely scrapped the citizenship status. So for anyone on this call who's a British national, British citizen, living overseas, likely to be overseas for the next 10 years, this is very, very good news. What it means is that now they've got what's called a long-term residence test. If you live outside the country for 10 years, even if you've got a British passport, if you leave the country for over 10 years, you're what's called a long-term resident. And you actually lose your ties for your worldwide assets to be taxed as inheritance tax. That means you no longer need to worry about your citizenship for all your worldwide assets, worldwide, not UK, are no longer taxable, are tested under UK inheritance tax. However, any UK-based assets, property, shares, ISAs, pensions, investment bonds, VCTs, EISs, anything you might hold in the UK would still be subject to inheritance tax. It's only your worldwide test comes off at that point. Big change and really interesting. What it also means for people is that people that move to the UK, I think about perhaps these foreign investors or business people. Most of them own a lot of London, people from the Far East and perhaps Asia and United Arab Emirates and Saudi Arabia and Russia, of course. These people will be coming over to the country, but if they spend 10 years in the country, they're then subject to inheritance tax on their UK assets. So it's a kind of flip. They're obviously looking at trying to capture the people living in the UK rather than people living outside. Second point, UK pensions and qualified recognised overseas pensions are now to be added to inheritable tax estate 2027. Big change. I feel like it's a way the Labour government have backfired against the lifetime allowance being dropped. Anyone with big pensions, British people on this call will remember the lifetime allowance being abolished just a few years by Rishi Sunak. So Rishi Sunak came out, we expected the lifetime allowance to be increased. What it basically means that anything above 1.055 million was taxed as an additional rate tax on pensions at 25%. That 25% on top of drawing down your 45% income tax bands, most likely. So it's an additional rate tax as called a lifetime allowance. They just abolished that a few years ago. It used to be up at 1.7 and then dropped to 1.5, 1.25. They just took it away. So now anybody sitting with 2 million pensions, 3 million pensions, perhaps joint, um, no longer have that kind of additional lifetime allowance tax. They took it away, which was very good for many people with those types of pensions. However, Labour have come in, rather than just reversing that to bring back in this kind of lifetime allowance, call it a wealth tax on pensions, so to speak. They've said, well, no, we'll just put all pensions into your inheritable estate. And this is going to take effect from April 2027. This is big change because a lot of people have been putting money into their pensions as a way of trying to mitigate their inheritance tax exposure, particularly with UK self-invested personal pensions and particularly with qualified recognised overseas pensions. These are pensions that are opened up in places like, I see a lot of them in Malta and Gibraltar where they've moved their UK pension, very similar structures, and it actually takes away any exposure to inheritance tax for the future. A SIP's a little bit different because previously they would be taxed as inheritance tax if you die after 75. Now, what they've said now is that from April 2027, all pensions, QROPs and UK SIPs, will be tested and it'll be up to the scheme administrators to hold back the 40%, so taking that control away from the policy holder to hold 40% for inheritance tax liabilities. Big change. And it's causing quite a bit of turmoil. You can imagine that people that are in the high net worth category living in the UK, clients that I have, are now immediately looking at ways to leave the UK. And this is probably part of the issues that, central left-wing governments have. They come in with these ideas and regimes to try and tax wealthier, tax more, but inevitably what it does is it actually pushes a lot of the high net worths out. These people have options, they have different properties abroad, they're going to move away for 5, 10 years, and they're going to look for ways to extract a pension without paying 45% income tax and paying 40% tax on death around getting around the inheritance. So a lot of change, a lot of food for thought if you're currently living in the UK, and a lot of things that I can, of course, assist you with. The reason I've thrown in the QROPs, anyone with a QROPs, QNOPs, QNOPs and QROPs and ROPs are just overseas pensions which people have transferred UK pensions to. This isn't on the slides because we just had the update from QB Partners, which are an extremely well-established tax specialist company. They went into a 12-week consultation with HMRC to get a firm answer whether QROPs would be included in inheritance tax. The answer is yes, they would be tested, which is also quite remarkable and quite shocking actually. So if you're in that category where you've tried to move abroad to get it inheritance tax free, no longer applies unless you're a long-term non-resident. But there are ways to try mitigate that. The third thing is foreign income and gains. Foreign income and gains is a new rule that's brought in, quite attractive for people going back to the UK, that was going to replace the old remittance rules from April 2025. And I'm going to come onto this slide to talk about that. So, foreign income and gains rules. This took effect April this year, 2025. So the only one is the pension and inheritance taxes April 2027. The other two, FIG, and of course your non-dom rules, took effect from April 2025 this year. Now, this new regime, if you've been outside the UK for more than 10 consecutive years, or you've never been to the UK, of course, as a foreigner, an expat, high net worth, or even just moving to the UK, when you move to the UK, you can now apply for 100% tax relief on all foreign income and gains coming from foreign assets into the country for a 4-year period only. Think about the non-habitual regime, the way it used to be, but for 4 years and a bit more attractive on the gains and income. So you can see where I'm going with this. There's always countries and regimes that are offering something that's trying to attract investors or people that promote the economy or high net worths or retirees to come. So, and these are the kind of things to be very aware of. Previously going back, there was also things in Malta and Cyprus that people were using, Greece as well. But the countries are always coming up with ways, governments change to make things attractive. So that's something to take note of if you're thinking about going back to the UK if you've been outside for 10 years. And something that has to be designed right because it's foreign income and gains, not if you've got UK assets again. Again, I can imagine some of you starting to think about inheritance tax, FIG rules, ways to minimize, way to mitigate, and that's kind of the stuff that I help people with. Okay. I hope everyone's following me so far. Just on I get a quick, maybe 5 second pause. Anyone who tuned out for the last few slides, perhaps because you're not British or not really got any UK ties, you can tune back in. All the British people, stay tuned because this is all relevant. In fact, this is probably one of the most relevant parts. I'm going to take, it's really hard for me to cover everything, but I'm going to just take the last kind of 20 minutes there that we've done on the kind of non-habitual, the changes in the UK, and just give you some kind of key financial planning tips to think about over the next few years and on these kind of last few slides of the presentation. So, right, you've got this gentleman or perhaps gentlewoman in the middle here. Um, and if you might be in this position, all right. There's a whole range of asset types that exist in the world, all right. And what I'm talking about here is financial structures, financial vehicles. I'm not talking about investment funds yet. I'm not talking about stocks or funds or bonds. I'm talking about the vehicle these are held in first. You've got the vehicle, and then you've got the investment element, the assets and the equities that are held within it. So I'm actually talking about the structure first, which a lot of people tend to skip to get to investments first. I'm talking about structures because there's lots of them, and each government treats structures in a different way. So if I just read some of these out, you've got ISAs, UK bonds, UK banks. You've got UK pensions, defined benefit, defined contribution, and self-invested personal pensions and personal pensions. You've also got European and international pensions, some of the things I touched on before. You've got government pensions, bank accounts and fixed deposits. And fixed deposits have been quite attractive with rates being higher recently. You've got direct investment platforms. So you've got a lot of these kind of trading apps now as well, which I'm wary of because they're not so insured. But you've also got your kind of big trading companies where you've got your equities and stocks access, life assured and life investment vehicles, properties, assurance Vs, things that are in the UK tax efficient, sorry, EU and tax efficient vehicles. You've got employer stock option schemes and share option schemes like RSUs and ISOPs and various other things that people have, quite common in Switzerland and Europe and US companies. And then you've got trusts and alternatives. So you can see where I'm going with this. I can't cover everything on this call. It's impossible. And quite frankly, I wouldn't want to because the likelihood of you having every one of these assets is very slim. But there might be some of you in the call that have got some of these, and you're wondering, well, how does that work from UK if I stay in Portugal, or if I go to the south of Spain to retire? And this is what I help with. So if you're on this call with these kind of questions, just feel free to email me at the end, drop us a message, and I'm more than happy to have, as I said, one of these kind of brief discovery calls just to get a bit more information and see if I can help. I'm going to focus on two key asset classes I want to differentiate. And it's important for non-habitual regime and a lot of this kind of UK side that I was referring to on the budget changes. On the left-hand side, you've got personal investments, and on the right-hand side, you've got pensions. The big difference, and personal investments have a wide category, right? They've got bank accounts, you've got trading platforms, life assured vehicles, you've got investment bonds and various other things, a wide range of things you can hold just on your personal name. Pensions are held by a trustee, a pension administrator, a PAS, different terms for these things, but they're held by a trustee. The big difference between a pension and a personal asset that I want to cover is that not so much, okay, control is different because one's your name, one's a trustee, but the big thing is that everything you take out of a pension is typically subject to income tax. Countries don't look through, the UK doesn't look through and differentiate how much you put into a pension, how much your employer put in, and how much growth you made to tax the growth. Because quite often when you're paying into a pension, you're paying tax. Excuse me, you get a tax rebate on the payments, which then means all of it's taxed on the way out. It's a unusual system because, of course, you've got your tax-free lump sum PCLS at 25% if you're a UK resident, not so much globally based on double taxation agreements. But after that, you're completely taxed at 45% tax if you're a high band or an additional ratepayer. And also now, when you pass away, it's taxed at 40%. High taxes. With personal investments are different because with personal investments, depending on what you hold dictates the tax rate, but you're never paid on the capital that you put in. So the capital that you put into a bank account or a trading platform or an investment platform or a bond is not taxable on the way back out. It's not a taxable asset because it's your net of earnings, your net of tax contributions to the personal investment. However, you'll pay tax on gains. And those gains, well, depending on the structure of the assets, if you've got accumulation in shares, they'll be taxed as capital gains tax. However, if you've got income producing assets, they'll be taxed as income. If you've got dividend producing assets, they'll be taxed as dividends or interest. So these are the kind of things, again, when I talk about different countries and how they're structured, to be wary of. Now, some of you may see where I'm going with this. Based on current rules, after your non-habitual regime, this is what your income tax rates look like in Portugal. This is from just a PwC cutout from March 2025. So for anyone that's looking for quite a common income rate I'm given, and I don't like to put a median on things because people are very different, right? I have people living off, a few thousand euros a month, and I have people living off 30,000 euros a month. Drastically different lifestyles. But I do find a common amount people ask for is 10,000 a month. It's fairly common. 10,000 euros a month, you're stepping in, because you're on 120,000 a year, you're stepping into this 48% tax bracket if you're drawing down income producing assets after your non-habitual regime. And this is what it looks like. So if you look at this below, excuse me, I need to sneeze, excuse me. If I sneeze, forgive me. So Portuguese income tax rates at the top. So you've got 120,000 euros being withdrawn a year, 10,000 euros a month. Taking into consideration the rates there, you've got a taxable liability of 46,000 euros each year on that drawdown if you're a single person after non-habitual regime. Now, this will come as quite a shock because anyone who's on the non-habitual regime, the previous one, not 2.0, the previous one before this year, will be used to paying nothing, no income tax on those kind of income coming into the country, or 10%. Big jump. If you're married, you've got some more bands you can utilise across both of you, but you'll still be paying 35,847 circa estimated again, bearing in mind these are from case studies, tax specialists. Don't take it for complete word at this stage, but 35,847 euro. So what should you be thinking about whilst you're on your NHR? Perhaps the things that people are now thinking about and things that I see a lot of people wanting to address with me who are living in Portugal more than anything. In fact, living in a lot of countries outside UK now, if you're non-resident UK, you're looking for ways that you can start to draw down your pension and quite aggressively and not leave much of a pension pot behind without stepping into the 45-48% tax bands. So utilising your non-habitual regime, utilising countries that have favourable DTAs and regimes to draw down pensions. Why? Because anything left behind in a pension is now taxed at 40% in the UK anyway. Also, if you come off your non-habitual regime, if you go back to the UK, if you go to a country with a high tax rate or Portugal, you're going to be paying 30, 40, 50% tax on your drawdowns. So if you get that pension into a net capital position, put it into a personal vehicle, it then kind of ensures all of that net personal asset, and you only ever pay tax on growth, which will be very small and minimal in comparison. And there's also ways to mitigate that I'll come to in a moment. I hope everyone's following me. If not, again, reach out for a call. Reduce inheritance tax exposure on UK assets. If you are planning to be a long-term non-resident UK outside the UK for 10 years, you want to start reducing your UK assets and exposure, investing into international property, European property, international vehicles, European vehicles to mitigate that UK inheritance tax exposure in the future. A lot of people use corporations, trusts, or even just selling and moving assets abroad. You can actually do things as well called in specie and asset transfers, moving existing portfolios out to foreign European, local or international platforms as well. As I mentioned, the third point here, I've already kind of covered this, but for private pensions like SIPs, QDOCs, personal pensions, you could be looking to start kind of aggressive withdrawing this income over your NHR period to reinvest into a personal vehicle. The other thing is there are vehicles in Portugal, like investment platform vehicles that you can invest into that hold equities and shares and different other types of stuff and mutual funds and ETFs that are what's called ICAE. They're Portuguese compliant. Now, the benefit there is that they have a capital gains tax relief. You'll notice before that people on the non-habitual regime, previous ones, you're always paying 28% capital gains tax. You might want to be utilizing vehicles that mitigate that. So these vehicles, if you invest through them, after an 8-year period, they give you a 60% exemption on all gains produced in the vehicle. So rather than paying 28% tax, you'll pay 11.2% effective rate, which is a huge exemption and reduction on those gains. So very good to utilize those vehicles for kind of your drawdown future planning if you're planning to stay in Portugal long term. They can also be quite attractive for people going away back through Europe or UK because these vehicles can be designed as assurance visa, UK offshore bonds, which also provide time apportionment relief, 5% tax withdrawals, and tax efficiency France. But these are things that I could cover in more detail. The other kind of fifth point I would say is, can you keep your options opened for future repatriation? Can you keep your options open for saying, well, I'll move to another country perhaps when my NHR moves up, or I'll leave the UK and go somewhere else? Of course, the attractive places at the moment is the Middle East, United Arab Emirates, Abu Dhabi, Dubai, even Saudi Arabia is becoming attractive now. I'm not sure for Westerners for retirement, but perhaps for people working, it's very attractive. And you've also got places in the Far East which can be quite attractive as well. You know, a lot of places in the Far East have a localized tax treatment whereby your kind of foreign income and gains are not subject to tax, only local stuff like Thailand and stuff like that's quite common for stuff like that. I don't do a huge amount across Atlantic, US, Caribbean, that kind of Southern American market, but we have specialists in those areas if you're thinking about moving to those countries. Okay, those are just some things I want to leave. I hope I've not left more questions than answers for people. Someone said that to me after a webinar once, a seminar in person actually. That's not my intention, but my intention is to get you thinking about your future, to get your structures and your planning right for your future. And there's some things I'm just going to cover on foreign countries before we finish up. One more thing I want to cover, because I'm just conscious of the time for everyone on the call, is the selling of real estate in Portugal as your primary residence. So a lot of you will be aware that there's some capital gains tax relief if you sell your primary residence. Now, one thing to note here, the taxable person or their spouse on the date of the transfer of the property or the sale must be demonstrably retired or at least 65 years old. If you fit one of those categories and you're selling your primary residence, and that the proceeds from that primary residence is going to be used to purchase one of three things: a life financial assurance contract, which the ICAE bonds come under, these platforms, an open pension fund in Portugal, or contribution to a public capitalisation scheme, then you will have a capital gains tax allowance which actually mitigates it. So that 28% we're referring to before. Interesting. It needs a case by case study, and I would refer you to one of our tax partners. We have a meeting with them to get this right for you. But something to bear in mind if you've got property in Portugal and you're looking to sell or even move abroad in the future to sell. Okay, before we finish, I would like to just leave a couple of key things about neighbouring countries. If you think you might move abroad, we just spoke about the UAE and the Far East there. Portugal we've covered in a lot of detail. Portugal's attractive for your non-habitual regimes previously, and even actually in a way now you're not NHR 2.0, but actually statistically high in income tax. Spain, oh, one more thing about Portugal is it's very good on gift and inheritance tax because there is none. So Portuguese local assets, your bonds and vehicles, they pass through beneficiaries for no inheritance tax, which is attractive. Spain's a very different structure, actually quite similar to Switzerland in a way. It's got a cantonal tax system. So each canton in Spain, like Switzerland, is has its own tax regime, its own tax rates. If you look at the Madrid compared to some of the southern cantons where a lot of your kind of foreigners go to and retirees and your Brits, then naturally your Madrid canton your taxes are a lot lower. And these vary from wealth tax to income tax to capital gains. Everything is different from each canton to another. So bear that in mind before if you're planning to move to Spain and which area you're going to and how the government's planning to make changes because the new government's really trying to clamp down on some taxes. Particularly around, foreigners' property and wealth. The other thing about Spain is it's quite attractive if you're drawing down annuities. So if you structure an annuity or you structure your pension into kind of a break off and a drawdown, you get a much reduced tax rate. So you only pay, 21% on 12% of the drawdown. So you think about that, you're drawing down 100,000 on an annuity, 12% is only subject to tax, that's €12,000. And then that's subject to 21%. I mean, that's only like, you're talking about €3,000 tax just off the top of my head, if you structure it right. Switzerland, notoriously a lot lower for tax than, if you look at the Schengen agreements, of course it's separate from Europe and the EU, but lower in tax, very attractive for business and working there, very attractive for startup companies, IT companies, because the corporation tax and the regime and funding is very, very good. Um, One thing to be aware of is wealth tax. If you're high net worth, cost of living is very high. It's not a very attractive place for people to retire. That's why a lot of people stay in the neighbouring countries. Switzerland is a very flexible regime, whereby when you leave the country, you can actually withdraw most of your pensions and assets out for a reduced tax. But be wary of that. It depends on the DTA. For example, the UK and the Switzerland DTA is very good because if you withdraw your pension out and you're resident in the UK, you only pay a one-off tax in Switzerland. which can be very, very low if designed right. You move it to the right canton. However, if you go to somewhere like France or Australia, funnily enough, then the GT is not so favourable because you still have to pay tax in the local country. Then you've got the UK. It's quite difficult to the way things are going in the UK. It's kind of taxed at every corner now. Trust planning is still a big thing. People still use limited companies, corporations as a way to help try and pass wealth through directors and family companies. Trust planning is still widely used as well. But also, of course, you've got your standard assets. But offshore investment bonds becoming a lot more attractive now because you can draw down 5% a year tax-free from your capital. And if you're an additional rate taxpayer, that's quite attractive, and the rest of the vehicle can accumulate tax-free. But onshore assets are hit really hard. Your capital gains tax relief's dropped from 12 grand to 3 grand. So it's pretty much non-existent anymore. Not attractive really at all for UK investments in onshore funds. You've got inheritance tax on pensions. So yeah, really, really strict at the moment. But we can cover it in more detail. Germany, France, again, both very strict as well. I wanted to throw it in here because my advice would be if you're trying to move to a jurisdiction for low tax for retirement, don't pick these countries. I get if you've got emotional ties, I get it, right? You move to these countries because it's where your home is, it's where you love, it's where you want to be. That's completely different. We have to work within that. But don't move there for tax efficiency. Is as simple as I can put it. Germany very strict. One thing about Germany is though is you've got a really booming property market in Berlin and Leipzig. A lot of big IT companies being built. Or, you know, you get we project a lot of projections from developers that how the Berlin and Leipzig property market's going to double within the next 7 to 10 years. Good rental yields. And also the attractive thing there is if you hold a German property for 10 years, there's no capital gains tax on selling. So they actually take all the capital gains tax away at source if you hold a property for 10 years. Quite an attractive thing if you're interested in property and don't know where to turn. France, assurance visa are used. It's a very socialist government country. Very good state pensions. Probably one of the best. Well, Switzerland actually is probably just a bit better. But very good state pensions if you're there long term. Beautiful, obviously, southern coast of France and different areas in the wine regions, but notoriously high on tax and very hard to get round. There's not much manoeuvring. All right. Good. A lot of the companies we work with, you'll recognize we work with over 400 companies because we're independent. But again, we would actually build a strategy with you first and then come back with companies to fit you. Good. Running okay for time. I'd like to thank everyone for coming on this evening's webinar. I am sure that somewhere everyone got some value. I appreciate not all of the information will be relevant to every single person. But as I said before, if you're looking to just get a better understanding and look at your position in a little bit of detail, I do discovery meetings for no charge. I normally find my discovery meetings can last 2 or 3 meetings to get a strategy and plan in place that fits you. But even if it's just a little information swap at the start to see if there's any common ground I can assist you, feel free to reach out. My email, my phone number, more than happy to help. I'm not going to take any questions this evening. As I said, if you've got any questions, just fire them across on email and the phone call. But thank you for joining and stay tuned. Sign up to our marketing. I do a lot of these events, both networking seminars, webinars, if you're in the country, Portugal or wider Europe. So stay tuned and hopefully see you in the future. Bye.